Welcome to the Deep Dive, the show that cuts through the noise and delivers the essential knowledge you need to be truly well informed. Today, we're diving into a fascinating and honestly often perplexing corner of federal tax law: community property rules.
Yeah, it can definitely seem complicated at first glance.
Absolutely. And this isn't just, for tax professionals listening in. If you live in one of the 9 community property states,
Mm.
Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, or maybe you're in a registered domestic partnership in Nevada, Washington, or California, or even if you're just like intensely curious about how certain legal frameworks can profoundly impact your financial life, then this deep dive is absolutely for you.
That's spot on. Our mission today is really to demystify this whole area. We're going to unpack the complex IRS guidance, particularly from publication 555. The goal is to distill it into actionable insights, things you can actually use that can directly impact your wallet.
Right.
We want to equip you with the knowledge to, identify, categorize, and accurately report your income, your deductions, your credits, especially when you're facing that really critical strategic decision. Should we file separately or should we file jointly? We want you to walk away from this deep dive with the clarity you need to make informed choices. Choices that can, hopefully, optimize your tax situation and help you avoid some surprisingly common pitfalls.
Okay, so let's start at the beginning. You might think where you live is simple, right? Just a street address.
This is like it should be.
But for the IRS, especially when community property comes into play, it's about something much deeper. It's about your domicile. And understanding this concept, well, it's truly the first most fundamental step in unlocking this whole tax puzzle.
Absolutely. Your domicile is the anchor for, well, pretty much everything that follows. It's your permanent legal home. It's the place you intend to return to indefinitely, and it directly dictates whether these community property laws even apply to your income, your assets, and consequently, your federal tax obligations.
Okay, permanent legal home. But how does the IRS know? They don't just take your word for it, right?
No, definitely not. They look at a whole range of factors to determine your true domicile. Think about it.
Yeah.
Where do you pay state income tax? That's a big one. Where are you registered to vote?
Makes sense.
Where is the bulk of your property located? What's your citizenship status? How long have you physically been in a particular place? And, maybe critically, what are your business and social ties to that community? Where are your connections?
So, a lot of factors.
A lot of factors play a part, yeah. But the ultimate factor, the deciding one, is your intent. Can you actually demonstrate that you genuinely intend a particular place to be your permanent home? That's the core question.
Okay, intent. That makes sense. So let's throw a curveball. What if someone moves around a lot, maybe a job transfer? What if you move into or out of a community property state, say, mid-year? Does that mean you just flip a switch and all your income for the whole year is treated one way or the other? How does that geographical shift affect how your income gets categorized? It sounds like it could get really complicated really fast.
It definitely adds a layer of complexity, no doubt about it. But the rules are actually designed to provide some clarity there. If your domicile changes during the year, let's say you move from California, which is community property, to Florida, which isn't,
Right.
you won't have a single blanket rule for the entire tax year. Instead, you'll likely find yourself with a mix. You'll have some community income and some separate income.
Ah, okay.
So income earned and property acquired while you were domiciled in California follows the community property rules. But the income earned and property acquired after you establish domicile in Florida, that follows Florida's rules, meaning it's separate.
Gotcha. So tracking becomes super important.
Absolutely essential. Meticulous tracking of when and where income was earned or property was acquired is key for accurate reporting in those transition years.
Okay, let's unpack this further then. Because the terms community property and separate property are like the absolute heart of this whole discussion. At its core, what is community property and how does it fundamentally differ from separate property in the eyes of the IRS? It feels like this is the key to unlocking major tax implications.
That's precisely it. Think of community property as, well, almost everything you and your spouse or registered domestic partner acquire during your marriage or RDP, but specifically while you were domiciled in one of those community property states.
Okay.
It's kind of the default assumption. If it's not clearly separate, it's probably shared, it's community. This also includes property you both explicitly agree to convert from separate to community.
Okay, makes sense.
Now, community income then flows directly from that shared pot. So this means income from community property itself, like, say, rent from a rental house you both own as community property, but it's also your salaries, your wages, any pay for services you perform during the marriage or RDP while living in that community property state.
Right, your paychecks.
Exactly. Even real estate that's treated as community property under your state law falls into this category. The income from it is community income. Separate property, on the other hand, is distinct. It's generally what you or your spouse owned before the marriage, or RDP.
Stuff you brought into it.
Precisely. It's also any money you earned while you were domiciled in a non-community property state. And importantly, if you receive a gift or an inheritance separately during your marriage, that usually remains your separate property.
Ah, okay. Gifts and inheritances are usually separate.
Usually, yes, if given to one spouse individually. Also, if you bought something with funds that were clearly traceable as separate, or you exchanged separate property for new property, that new property typically keeps its separate status. And just like you can convert separate to community, you can also sometimes convert community property to separate through a legally recognized state agreement, like a postnote.
Okay. And separate income.
Separate income is generally the income generated directly from that separate property, and it belongs only to the spouse or RDP who owns that separate asset. It's usually a pretty clear line, in most cases.
Okay, most cases. But here's where it gets really interesting, and I think this could truly surprise some people listening. You'd naturally assume income from separate property would always be separate income, right? Seems logical.
It does seem logical, yeah.
But the IRS publication, Pub 555, specifically highlights this fascinating and potentially very impactful nuance. In Idaho, Louisiana, Texas, and Wisconsin, income from most separate property is actually considered community income.
That's the big exception.
That's a massive distinction compared to states like Arizona, California, Nevada, New Mexico, and Washington, where income from separate property is separate income. What are the practical implications of that? That state-specific variation sounds like a huge potential trap for people who aren't aware.
It absolutely is a potential trap, and it really underscores why knowing your specific state's laws is so important, even when you're dealing with federal tax rules.
Yeah.
Let's use your example. Say you own a rental property before you get married, and it's located in California. The rent you collect from it after you get married remains your separate income. You report 100% of it on your tax return if filing separately. Simple enough.
Okay.
But now imagine that same premarital rental property is in Texas, because Texas is one of those special states.
Yeah.
The rent generated during your marriage would typically be considered community income,
Wow.
which means if you and your spouse file separate federal returns, you'd each report half of that rental income,
Even though you own the property beforehand.
even though you own the property beforehand. The income generated during the marriage from that separate asset becomes community income in those 4 states. This can drastically change your individual tax liability, right? Especially if one spouse has significant separate assets generating income. A larger chunk of what might seem like my income gets pulled into the community pot, requiring that 50-50 split for tax reporting.
That's a huge difference.
It's a fundamental difference in how wealth generated from individual assets is treated. Definitely a key insight for tax planning if you live in Idaho, Louisiana, Texas, or Wisconsin. You have to know that rule.
Definitely need to check your state law on that one. Okay, and speaking of specific categories, let's talk about registered domestic partnerships, or RDPs. Now, you mentioned they often follow state community property laws, but crucially, they are not considered married for federal tax purposes. How does that distinction play out on their federal tax return? What does it mean for tax savings?
This is a really critical area for RDPs, and often a source of confusion. While state community property laws might say, okay, RDPs, you treat your income and property as community. For federal tax purposes, the IRS is clear. RDPs are not married. So generally, they still report half of the community income and all of their separate income, similar to married folks filing separately in community property states. The income splitting concept still largely applies.
Okay.
However, because they aren't recognized as married federally, they face specific limitations that married couples don't.
Ah, limitations. Like what?
Well, for instance, an RDP cannot use their partner's earnings when calculating earned income for claiming some really key federal credits. Things like the dependent care credit, the refundable part of the child tax credit, or the earned income credit. You can only use your own earnings. That's a significant potential disadvantage compared to married couples.
Wow, okay. That could make a big difference.
It really could. Furthermore, IRA deductions can't be split between RDPs. Each partner's deduction is figured totally separately based on their own eligibility and income.
So no sharing the IRA deduction benefit.
Correct. On the plus side, though, federal income tax withheld from community wages is split equally between them. So each RDP gets credit for half of the taxes withheld from those shared wages, which makes sense since they're reporting half the income.
Okay, got it. So for both married couples filing separately in these states and RDPs, there's a specific form that becomes really important, isn't there? Form 8958. It feels like this form is sort of the central piece of paperwork for showing the IRS how you've handled all these allocations.
That's an excellent way to put it. Form 8958, allocation of tax amounts between certain individuals in community property states, is absolutely crucial. It's basically your transparency document for the IRS.
Your work paper, almost.
Exactly.
Yeah.
If you're married filing separately in a community property state, or you're an RDP in Nevada, Washington, or California, you must complete and attach this form to your federal return. No ifs, ands, or buts. It's used to clearly show the IRS how you figured out and allocated your community income, your separate income, deductions, credits, withholding, everything,
Right.
according to your state's community property laws. It ensures they understand exactly how you arrived at the numbers on your separate return. It prevents confusion, potential questions, maybe even audits down the line.
So don't forget Form 8958.
Definitely don't forget Form 8958. Your return is considered incomplete without it in those situations.
All right. Now that we've laid that foundation, domicile, community versus separate, RDPs, Form 8958, let's get into the nitty-gritty. The details that really hit your wallet. How your actual paychecks, your investments, maybe even retirement accounts get sliced and diced under these community property rules. This is where understanding the specifics can really make a difference on your tax return, right? Maybe
Right.
even save you some money.
Indeed, this is exactly where the theory meets the road, meets the practical application. And knowing these specifics item by item can directly impact your tax liability. So let's break down some common income sources. First, wages, earnings, and profits from a sole proprietorship. Generally, these are considered community income if they're earned while you're domiciled in a community property state.
So split 50-50.
Split evenly,
Okay.
50-50, between spouses or RDPs for federal income tax purposes when filing separately. For example, if one spouse earns a $100,000 salary and they file separately, each spouse would report $50,000 of that salary on their individual federal return,
Even if the other spouse didn't work at all.
even if the other spouse didn't work at all. This is a fundamental concept that often surprises people new to community property. Half of your earnings are attributed to your spouse for federal income tax if you file separately.
Okay, what about investment income, like dividends, interest, rent?
Good question. For dividends, interest, and rents, their classification really depends on the source property.
Right.
Where did the income come from? If it originates from community property, say, you and your spouse jointly own a rental property as community property, the rent is community income, split 50-50.
Makes sense.
Same for interest on a joint savings account funded with community money. If it earns $1,000 in interest, you each report $500. However, income from separate property, like dividends from stock one spouse owned before the marriage, well, that follows those tricky state rules we've talked about.
Ah, right, the 4 states versus the others.
Exactly. In Arizona, California, Nevada, New Mexico, Washington, that dividend income remains separate income belonging only to the owner's spouse. But, and here's that key distinction again, in Idaho, Louisiana, Texas, and Wisconsin, income from most separate property, like that stock dividend, becomes community income
And it's split 50-50.
and gets split 50-50. Again, a seemingly small difference on paper that can have a big impact on your individual taxable income and your tax bill.
Definitely need to know your state. Okay, what about alimony received? That's changed recently, hasn't it?
Yes, that's seen one of the most significant shifts thanks to the Tax Cuts and Jobs Act, the TCJA, back in 2017. For divorce separation agreements executed after December 31st, 2018.
Okay, post-2018 agreements.
Right. For those newer agreements, amounts paid as alimony are no longer deductible by the person paying it. And, crucially for this discussion, they are not includable in the income of the person receiving it.
So the recipient doesn't pay tax on it anymore.
For post-2018 agreements, generally, no. It's not considered taxable income. This is a huge change.
Why did they change that? What does it mean now?
Well, the reasoning was partly simplification, but it fundamentally shifted the tax burden. Before 2019, the paying spouse got a deduction, effectively sharing the tax benefit, while the recipient paid income tax. Now, for new agreements, that deduction is gone. The higher earner, often the payer, bears more of the tax burden, and the recipient doesn't report it as income.
So that really changes the negotiation in a divorce, huh?
Dramatically. Yeah. It impacts financial planning, settlement amounts. It's a key insight people need to understand. Now, for pre-2019 agreements, the old rules generally still apply, unless the agreement was specifically modified after 2018 to adopt the new rules. Under those old rules, community income could still affect the taxable amount of alimony received, but for most current situations involving new agreements, alimony received isn't income.
Okay, good to know. What about selling assets? Gains and losses?
The classification there hinges entirely on the underlying property. Is the asset community or separate? If you sell stock that was your separate property and you have a loss, that's your separate loss. You deduct it on your return.
Right.
But if you sell, say, your primary home, which you both own as community property, and you have a gain or loss, that gain or loss is community.
Split 50-50 again?
Split 50-50 for reporting purposes on separate returns.
Yeah.
It all comes down to tracing the property's origin. Was it yours before or acquired during the marriage with community funds?
Okay. Now, you mentioned IRAs earlier for deductions. What about withdrawals from IRAs and Coverdell ESAs? Is that community income?
This is a really important exception. Withdrawals from traditional IRAs, Roth IRAs, Coverdell education savings accounts. This is where federal law completely overrides state community property rules.
Completely override.
Yes. By federal law, these accounts are always deemed to be the separate property of the individual whose name is on the account,
Regardless of where the money came from.
regardless of whether community funds were used to contribute to it. Even if you both put community earnings into an IRA titled solely in one spouse's name, when that money comes out as a taxable distribution, it is 100% taxable only to the account holder, the person named on the account.
Wow. Okay.
That individual is also solely liable for any early withdrawal penalties or other taxes associated with that distribution.
So no 50-50 split on IRA withdrawals?
None whatsoever. It's all in the account owner. This can have big implications for tax planning, and especially in divorce settlements when dividing assets. That future tax liability isn't shared.
Good to know. What about pensions? That seems like it could be complicated.
Pensions are another area where tracing is vital. You need to figure out how much was earned during community property periods versus non-community property periods. They're characterized as community or separate income based on the periods of participation in the plan while married or in an RDP and domiciled in a community property state.
So you have to look at the timeline.
Exactly. The IRS uses a clear example. Henry Wright worked 30 years in civil service. For the last 15 of those years, he was married and lived in a community property state.
Okay, half the time.
Right. Since half his service, 15 out of 30 years, happened under community property conditions, half of his civil service retirement pay is considered community income. So if he gets $1,000 a month in retirement, $500 of that is community income.
Meaning $250 for him, $250 for his spouse filing separately.
Precisely. The other $500 earned during the first 15 years before moving to the community property state or before marriage is his separate income, taxable only to him.
So he reports $250 plus $500. His spouse reports $250.
Correct. It's this proportional allocation based on the time spent earning the benefit under community property rules.
And military retirement pay. Similar idea.
Very similar principles, yes. Active military pay and military retirement pay are generally community income if earned while married and domiciled in a community property state. If it's community income, it's considered received half by the service member and half by the spouse for income tax purposes. This often needs careful attention, maybe even specialized advice for military families.
Okay, partnership income.
For partnership income, if the partnership interest itself is community property, or if the income from that partnership is directly attributable to the personal efforts of either spouse or RDP, then that partnership income is generally community property. It's like earned income generated through their work.
Makes sense.
However, if it's an interest in a partnership that's separate property, and the income isn't mainly due to the individual's efforts, maybe it's passive income from an investment partnership they owned before marriage, then the income follows the rules for income from separate property.
Meaning it could be separate or it could be community, depending on those 4 special states.
Exactly. Depends on the state again.
Okay, what about tax-exempt income? Like muni bond interest?
Generally, tax-exempt income keeps its exempt status for both spouses. For instance, if one spouse works abroad and qualifies for the foreign earned income exclusion, that excluded income is also exempt for the other spouse on their separate return, even if the other spouse didn't personally meet the conditions.
Oh, that's interesting.
It is. RDPs, however, should probably check the specific rules for the exclusion they're claiming, just to be sure the exempt status flows through, as federal recognition isn't always the same.
Good point. And just to hammer it home one more time, that income from separate property rule.
Yes, it bears repeating because it's so crucial and state-dependent. Arizona, California, Nevada, New Mexico, Washington. Income from separate property is generally separate income, belongs to the owner.
Yeah.
Idaho, Louisiana, Texas, Wisconsin. Income from most separate property is treated as community income, gets split 50-50.
Got it. Know your state.
Know your state. That's the mantra for this topic.
Okay, so that's a really thorough look at how different income streams get treated. But often what matters just as much for your final tax bill are the deductions, right? The things that reduce your taxable income. Does the money going out follow the same community property logic? Or are there different rules here, especially if you're looking for tax savings?
That's a great question. And yes, just like income, how deductions are allocated often depends on whether the expenses relate to community income or separate income. The goal is always consistency, matching the expense to the income it generated.
Okay, so what about business and investment expenses?
Right. Well, first, a quick heads up about investment expenses. The TCJA suspended the deduction for most miscellaneous itemized deductions, which includes things like investment advisory fees under Section 212, at least through 2025.
Ah, right. Those are mostly gone for now.
Mostly gone for individuals, yeah. But business expense deductions under Section 162 for your active trade or business, those are definitely still applicable. So if you file separate returns, expenses you incur to earn or produce community business or investment income are generally divided equally between you and your spouse or RDP.
Split 50-50, like the income.
Exactly. It mirrors the income split, so you each deduct half on your separate returns. Conversely, expenses related to earning separate business or investment income are deductible solely by the spouse or RDP who earns that corresponding separate income.
Match the deduction to the income owner?
Precisely. It ensures the deductions offset the correct income stream, which is important for accurate tax calculation and maximizing those deductions.
Okay. What about the IRA deduction? Can you split that if you use community funds to contribute?
No, you cannot. This is another one of those areas like IRA withdrawals, where federal tax rules specifically override state community property laws.
Okay, federal rule wins again.
Federal rule wins. The deduction for contributions to a traditional IRA is figured entirely separately for each individual. It's based on their own earned income, their AGI limitations, whether they're covered by a retirement plan at work, etc., without any regard to community property.
So even if I use our joint checking account money, which is community funds, to put into my spouse's IRA.
Only your spouse can potentially claim the deduction on their return, assuming they meet all the other IRA deduction requirements. You can't claim half of it.
Got it. No splitting the IRA deduction. What about personal expenses? Things like medical expenses or maybe charitable contributions?
For personal itemized deductions like medical expenses, the allocation depends on the source of the funds used to pay them.
Okay, follow the money.
Follow the money. If these expenses are paid out of clearly identifiable separate funds, maybe from an inheritance one spouse received, then the deduction belongs solely to the spouse who paid it with their separate money.
Makes sense.
But if these expenses are paid from community funds, like from that joint checking account funded by both your salaries, community wages, then the deduction is normally divided equally between the spouses or RDPs on separate returns. The idea is that it was a community obligation paid with community money.
So medical paid from the joint account gets split 50-50 for the deduction.
Generally, yes, if you're itemizing and filing separately.
This really highlights the need for good record keeping, doesn't it? Knowing if money is community or separate.
Absolutely. Good record keeping is paramount when dealing with community property, especially if you anticipate filing separately or if you have significant separate assets.
Okay, this naturally raises another question. When we talk about tax credits or things like self-employment tax or even just how we pay our taxes throughout the year, does community property still play a role there? And are there specific tax-saving opportunities or maybe limitations we should be aware of in that context?
It absolutely does play a role, and these are often areas where mistakes happen or potential savings are missed because the rules can be a bit counterintuitive. Let's walk through some key ones.
Okay.
First, the child tax credit and the credit for other dependents. The amount of these credits can be limited if your modified adjusted gross income or modified AGI goes above certain thresholds.
Right, the phase-outs.
Exactly. And those phase-out thresholds depend on your filing status. So when you split income under community property rules by filing separately, it's possible that doing so could lower one spouse's AGI enough to keep them below a face-out threshold, potentially allowing them to claim a larger credit than they might have on a joint return.
Ah, so splitting income could help qualify for more credit sometimes.
It could, but it could also work the other way or make no difference. It really requires running the numbers. Splitting income might also mean neither spouse qualifies for as much credit as they would jointly. You have to calculate it
Yeah.
carefully.
What about self-employment tax? If a business generates community income, do both spouses pay SE tax?
No, and this is a very specific rule for married persons. For net income from a sole proprietorship, that is community income, the self-employment tax, that's Social Security and Medicare tax for the self-employed, is imposed solely on the spouse who is actually carrying on the trade or business.
Even if the income is split 50-50 for income tax.
Correct. Even though the income might be split 50-50 on separate Form 1040s for income tax purposes, the self-employment tax liability falls entirely on the spouse running the business.
Interesting. So one spouse reports half the profit but pays zero SE tax on it.
Exactly. The other spouse reports the other half of the profit and pays SE tax on the entire net earnings from self-employment from that business.
What about partnerships?
For partnerships, it's even clearer. All of a married partner's distributive share of income or loss from a partnership trade or business is attributed to that partner for calculating self-employment tax. Doesn't matter if some portion is considered community income for income tax purposes. The partner pays the SE tax on their full distributive share.
Okay. And RDPs?
RDPs are different here. They generally report community income for self-employment tax purposes the same way they do for income tax, meaning they would typically split the self-employment income and potentially both pay SE tax on their respective shares.
Wow. Okay. So SE tax rules differ significantly between married couples and RDPs in community property states.
They do. It's a key distinction.
Okay. How about taxes already paid, like federal income tax withheld from paychecks?
If you and your spouse file separate returns and you each report half of the community wages, then it makes sense that each of you gets credit for half of the income tax that was withheld from those community wages.
So the withholding credit follows the income split.
Exactly. It ensures a proportional allocation. If you report half the income, you get credit for half the tax paid on that income. Same applies to RDPs, splitting community wages and withholding.
Makes sense. What about estimated tax payments if you pay estimated taxes during the year?
Well, you apply the regular estimated tax rules to your estimated income. If you expect to owe and want to pay separately, and remember, RDPs must pay estimated taxes separately federally. You figure out your obligation by taking into account half of your estimated community income and deductions, plus all of your separate income and deductions.
Okay.
But here's a flexible point. Whether you and your spouse pay estimated tax jointly or separately during the year does not lock you into filing joint or separate income tax returns later.
Oh, interesting. So you can pay jointly but file separately, or vice versa.
Yes, you have that
Big.
flexibility.
Yeah.
If you did pay estimated tax jointly, using both Social Security numbers, but then you decide to file separate income tax returns, you can claim all of the joint estimated tax paid on your return, or your spouse can, or you can divide it between yourselves in any way you agree upon.
That seems like a good planning opportunity.
It really is. For instance, if one spouse ends up having a much higher tax liability on their separate return, you might agree to allocate more, or even all, of the joint estimated payments to that spouse's return to reduce their balance due.
What if you can't agree?
If you can't agree, the IRS has a specific formula. Your share of the joint payments equals the total estimated tax paid times the tax shown on your separate return, divided by the total tax shown on both your return and your spouse's return.
Okay, there's a fallback formula.
There is. And of course, if you paid your estimated taxes separately under your own Social Security number, then you only get credit for what you personally paid.
Got it. What about the earned income credit? BIC. You mentioned RDPs can't use partners' earnings. What about married filing separately?
Generally, the EIC is not available if your filing status is married filing separately. Full stop.
Another big disadvantage of filing separately.
A huge one. It's often a major reason why filing separately just doesn't make financial sense for many lower and moderate income families. Now, there's a small exception if you're married, but qualified to file as head of household under those special rules for married taxpayers living apart. If you live in a community property state and meet those considered unmarried tests, your earned income for EIC purposes does not include any amount earned by your spouse that community property law might attribute to you.
Okay.
Your earned income for EIC purposes in that specific scenario includes the entire amount you actually earned yourself, even if community property rules split some of it to your spouse for the main income calculation.
So it prevents you from getting EIC based on income your spouse earned, but community property law gives you half of.
Exactly. It's a very specific rule designed for that living apart situation
Yeah.
to ensure the EIC is based on your work efforts when filing separately under those conditions. RDPs face similar limitations based on their own earnings.
Okay. Lastly, overpayments. If you get a refund on a joint return, can creditors of just one spouse take the whole thing?
That depends on state law regarding community property and separate debts. The allocation of a joint overpayment follows the community property laws of your state. If your state law says community property is subject to premarital or other separate debts of either spouse.
Like old student loans or back taxes from before the marriage?
Exactly. Then the full joint overpayment could potentially be used to offset that separate obligation of one spouse. The whole refund could be seized.
Ouch.
Yeah. However, if your state law protects community property from the separate debts of one spouse, then only the portion of the joint overpayment that is allocated to the spouse who actually owes the debt can be used to offset it.
So the other spouse's share of the refund would be protected.
Generally, yes, their portion could be refunded. This can be really critical if one spouse has significant outstanding liabilities that predate the marriage or are unrelated to the community. It offers a layer of protection for the other spouse's share. Again, hinges on state law.
Okay, this has been incredibly detailed on how things are usually split. But now, let's explore a fascinating twist. The IRS actually outlines specific scenarios where community property rules might be disregarded, but, importantly, only for spouses, not RDPs, right?
That's a crucial point to emphasize right up front. These special disregard rules we're about to discuss apply specifically to married individuals. They generally do not apply to registered domestic partners.
Okay. So what are some of these key exceptions where spouses might not follow the standard community property split for federal tax? Why are these important?
They're important because they address fairness and practical realities in certain situations. One scenario is when certain community income is not treated as community income by one spouse.
How does that work?
Imagine one spouse receives an item of community income, maybe a bonus check they conveniently forget to mention to their partner. If that spouse treats that income as solely theirs, pockets it, uses it, whatever. And crucially, they do not notify their spouse of the nature and amount of that income by the tax return due date, including extensions.
So they keep it secret.
Essentially, yes. If they do that, then the IRS says that spouse, the one who acted unilaterally and kept the other in the dark, is solely responsible for reporting all of that income item on their own tax return.
Ah, so they can't hide it and then later say, oh, but it was community income, you owe tax on half.
Exactly. It prevents that kind of manipulation and protects the unsuspecting spouse from being blindsided by tax liability on income they never knew about or benefited from.
Okay, that makes sense. What else?
Another really significant area is relief from liability for tax, attributable to an omitted item of community income. This is often referred to as innocent spouse relief in a community property context.
Innocent spouse relief, okay.
You might be able to get relief from tax, interest, and penalties on an item of community income that your spouse failed to report if you meet several strict conditions.
What are the conditions?
First, you didn't file a joint return for that tax year. Second, you yourself didn't include that specific item of community income in your own gross income. Third, the omitted income has to fall into certain categories, typically things like wages or self-employment income earned by your spouse or income from their separate property in those states where it generates community income. Fourth, and this is key, you have to establish that you did not know of and had no reason to know of that particular item of community income when you filed your return.
So you have to prove ignorance, basically.
You have to demonstrate lack of knowledge or reason to know. And finally, considering all the facts and circumstances, it would be unfair to include that omitted income in your gross income.
Seems like a high bar.
It can be, yes. The IRS looks at factors like whether you received any benefit from the omitted income, whether your spouse deserted you, whether you were separated or divorced. You typically request this relief using Form 88857, and Publication 971 has more details. It's critical safety net, but you have to meet the criteria.
Okay. What about agreements between spouses? Can they change the rules?
Yes, spousal agreements can definitely play a significant role. In many community property states, married couples are allowed to enter into legally binding agreements like prenuptial or postnuptial agreements that specifically alter the character of their property or income. They can agree to convert community property to separate, or vice versa.
So they could agree, say, that all future earnings will be separate property.
Exactly. A valid agreement under state law could stipulate that, and if so, the IRS would generally respect that agreement for federal tax purposes. It's absolutely essential to check your specific state law on the validity and effect of such agreements, as they can fundamentally change your tax reporting obligations compared to the default rules.
Okay. And you mentioned non-resident alien spouses earlier.
Right. If you're a U.S. citizen or a resident alien married to someone who is a non-resident alien, you have a choice. You can choose to treat your non-resident alien spouse as a U.S. resident for tax purposes for the entire year.
Why would you do that?
The main reason is usually to be able to file a joint return, which often results in lower tax than filing separately. If you make this choice and you live in a community property state or country, you then apply the standard community property rules for allocating income and deductions on that joint return.
Do you have to file jointly forever then?
No, you must file jointly for the year you make the choice, but you can choose to file joint or separate returns in later years. Now, if you don't make that choice to treat them as a resident, your community income is generally treated under rules similar to the spouses living apart all year, rules we're about to discuss, but without needing to meet all four conditions. It simplifies things slightly.
Okay, so let's talk about those spouses living apart all year rules. That sounds like a big one.
It is a major exception, and it's designed to provide clarity and potentially simpler tax filing for couples who are separated but not yet divorced. Essentially, this rule allows married couples who are financially and physically separated to treat most of their income for tax purposes as if they were single, effectively disregarding the default community property sharing for certain income types.
That sounds really helpful in a difficult situation, but there are strict conditions, right? You mentioned 4.
Yes, all four of these conditions must be met for the entire calendar year. 1. You and your spouse lived apart for the entire calendar year. No living together at all during the year.
Okay, complete physical separation.
2. You and your spouse did not file a joint return for a tax year beginning or ending in that calendar year. 3. You and your spouse had earned income for the year that is community income under state law. If all income was separate anyway, the rule doesn't apply. And 4. You and your spouse have not transferred, directly or indirectly, any significant portion of that earned community income between yourselves before the end of the year.
What counts as a transfer?
The IRS clarifies that this doesn't include payments for child support or, de minimis amounts, very small, insignificant transfers. It's aimed at situations where spouses are essentially still pooling their earned income despite living apart.
Okay, so if you meet all 4 conditions, then what?
You must disregard community property law when reporting certain specific types of income. It's not optional.
Which types?
Okay, here's the list. Earned income, like wages, salaries, professional fees, is treated as the income of the spouse who actually performed the services to earn it. No 50-50 split. Trade or business income, that is from a partnership, is treated as belonging solely to the spouse who is carrying on that business. Partnership income or loss is treated as belonging to the spouse who is the actual partner. Income from the separate property of one spouse is treated as the income of that spouse, which it usually would be anyway, except in those 4 special states, but this rule reinforces it. And Social Security benefits and equivalent railroad retirement benefits are treated as the income of the spouse who actually receives the benefits.
So basically, most income gets tied back to the person who earned it or owns the source asset.
Pretty much, for those specific categories. Any other community income, like maybe interest or dividends from a joint account that's still considered community property, that income is still generally treated according to your state's community property law, usually split 50-50, even if you meet the living apart rule.
Ah, okay, so it doesn't make everything separate.
Not necessarily everything, but it handles the main earned income and business income streams in a way that reflects the separation. The IRS Pub 555 gives a great example with George and Sharon. They're married, live apart all year in a community property state, don't file jointly, don't transfer funds.
Okay, they meet the conditions.
Right. George earns $20K wages, $5K consulting income, small prop, $1K dividends from a separate stock. Sharon earns $22K wages, $10 from her partnership interest, $2K dividends from her separate stock. They also have $1K interest from a community property savings account. Ordinarily, without this rule, they'd pool all the community earnings, $20K plus $5 plus $22K plus $10, $57K, plus the community interest, $. Total $58K community income. They'd each report $29K plus their own separate dividends.
Right, the standard split.
But because they meet the living apart all year rule, they disregard community property law for the earned income, business income, partnership income, and separate property income. So George reports his full $20K wages, his full $5K consulting income, his $K separate dividends, plus his $500 half of the community interest, total $26,500. Sharon reports her full $22K wages, her full $10K partnership income, her $2K separate dividends, plus her $500 half of the community interest, total $34,500.
Wow, that's a really different
A
outcome.
significantly different outcome. It clearly shows how these special rules can dramatically change the income reported on individual returns, providing a much simpler and often more logical tax treatment during a separation even before divorce is final.
Okay, so those are the rules for when the community property rules are disregarded while the marriage is technically still ongoing. But what happens when the community actually ends? Through death or divorce? These are obviously huge life events with major tax implications, right?
They certainly are. When the marital community or the RDP community legally ends, the assets are typically divided and specific tax rules kick in, particularly regarding property basis and income cutoffs.
Let's start with the end of the community due to the death of a spouse. What happens then?
This is where community property ownership offers a potentially substantial tax benefit for the surviving spouse, especially concerning capital gains tax down the road. It involves the concept of basis.
Basis being what you originally paid for an asset, generally.
Generally, yes, or its value when acquired. So if you and your spouse own community property and one of you passes away, the tax basis of both halves of the community property, the deceased spouse's half and the surviving spouse's half, gets adjusted to the fair market value, FMV, of the property at the date of death, or an alternative valuation date.
Both halves. Even the survivor's original half.
Yes, both halves. This is often called a double step-up in basis, or step-down if the value decreased. This rule applies if at least half the value of the community property interest was includable in the deceased spouse's gross estate for estate tax purposes, which is usually the case.
Okay, and why is that a benefit?
Let's use the Taylor and Blake example from the publication. They own community property, maybe a house, with an original basis of $80,000. When Taylor died, the house's fair market value was $100,000.
Okay.
Since half the value, $50,000, was included in Taylor's estate, the basis of Blake's half gets stepped up to $50,000, half of the FMV. The basis of the half inherited from Taylor is also $50,000. So the entire property now has a new, stepped-up basis of $100,000 in Blake's hands.
Ah, I see. So if Blake sells it later?
Exactly. If Blake later sells the property for, say, $110,000, their taxable capital gain would only be $10,000. $110,000 sale price minus the $100,000 stepped-up basis.
Instead of a $30,000 gain based on the original $80,000 basis?
Precisely. That step-up eliminates the capital gains tax on all the appreciation that occurred during Taylor's lifetime, up to the date of death. It's an extremely valuable benefit, unique to community property states for surviving spouses.
What about RDPs? Do they get this double step up?
Unfortunately, no. Registered domestic partners generally do not receive this federal basis adjustment on the surviving partner's half of the community property. That's a major difference in federal tax treatment upon death compared to married couples.
Wow, okay. Big difference there. Now, what about the end of the community through divorce or separation? How are assets divided then, tax-wise?
Generally, for married spouses, the division of community property in connection with the divorce or a property settlement agreement does not trigger a taxable gain or loss.
Even if one person gets more than half or different assets?
Even in an unequal division incident to divorce. This is covered by a specific part of the tax code, section 1041, which treats transfers between spouses, or former spouses if the transfer is related to the divorce, essentially as non-taxable gifts. The spouse receiving the property takes it with the community's original basis, so no immediate tax is due on the transfer itself. This is crucial because it allows couples to divide assets like houses or investments without having to come up with cash to pay taxes immediately.
That's a huge relief during a difficult time.
It absolutely is. However, again, the rules can be different for registered domestic partners because Section 1041 generally doesn't apply to transfers between RDPs. An unequal division of community property in a property settlement when an RDP ends may result in a taxable gain or loss for the partner who transfers more than their share. It's treated more like a sale or exchange.
Another key difference for RDPs.
Yes. Regardless of status, married or RDP, though income earned before the community ends is still split. Each person is taxed on half the community income for the portion of the year before the community officially terminated. Any income received after the community ends is then considered separate income and is taxable only to the individual who receives it or to whom it belongs under state law post-separation.
So defining when the community actually ends is critical. How does that happen?
It depends on state law, but generally it can end in several ways.
Yeah.
An absolute decree of divorce or annulment clearly ends the community in all states. Interestingly, even if an annulment says no valid marriage ever existed, it usually doesn't wipe out community property rights that arose during the time the parties believed they were married.
Yeah.
A decree of legal separation or separate maintenance might or might not end the community. You have to look at the specific court order. Often, the court will explicitly terminate the community property rights and divide the property as part of that decree. A written separation agreement can also end the community if it's legally binding under state law and clearly states that the parties are dividing community property and that all future earnings and acquisitions will be separate property.
So a formal agreement can do it.
Yes. And finally, in some states like Washington, the marital community might end simply when the spouses permanently separate with the intention of ending the marriage, even without a formal court order or written agreement. But this varies by state.
So again, check your state law.
Always check your state law for the specific event that terminates the community. RDPs also need to know their state's rules for when their partnership and community property rights end, as that determines the income cutoff date.
Okay, we've covered domicile, definitions, specific items, special situations, how the community ends. So what does all of this boil down to for you, the listener, when you're actually sitting down, looking at that tax form, trying to figure out the best way to file? This feels like where the rubber meets the road, where knowledge translates into real strategic decisions, maybe even tax savings.
This is absolutely the critical decision point for many married couples in community property states. And it's where you can actively use your understanding of these rules to potentially optimize your tax situation. Now, as a general rule, filing a joint return will almost always give married couples a greater tax advantage.
Why is that?
Well, the tax brackets for joint filers are wider, meaning more income is taxed at lower rates compared to the married filing separately brackets. Plus, many credits and deductions are either unavailable or significantly limited for separate filers, as we'll discuss. So, jointly usually means less tax overall.
Usually, but not always.
Not always. And this is what's fascinating, and where the core tax-saving method comes in for this context. The IRS itself, in Publication 555, actually recommends that if you live in a community property state, you should figure your tax both ways.
Calculate it jointly, A&D separately.
Exactly. First, figure the tax on a joint return. Then, figure the tax for both spouses on separate returns, meticulously applying your state's community property laws to split income and deductions, using Form 8958. Then you compare the total tax liability, the sum of the tax on the two separate returns, versus the tax on the one joint return. Whichever method results in less combined tax is the one you can choose.
So doing that comparison is the tax-saving strategy here.
That due diligence, that comparison, is the fundamental tax-saving strategy offered by the interaction of federal filing statuses and state community property laws.
Are there common situations where filing separately might actually save money?
They're less common. But yes, there are specific scenarios. For example, if one spouse has very high medical expenses are only deductible to the extent they exceed 7.5% of your adjusted gross income, AGI.
Right, the AGI threshold.
If filing separately significantly lowers that spouse's individual KGI, they might be able to deduct a larger portion of their medical expenses compared to filing jointly, where the combined AGI would be higher.
Ah, okay. Any others?
Similar logic could apply to miscellaneous itemized deductions, subject to a 2% AGI floor, if those ever come back, or certain casualty losses that also have AGI limitations. Another possibility, though complex, is if income levels on a joint return push you over phase-out thresholds for certain credits or deductions, but filing separately keeps one or both spouses under those limits.
So it really comes down to the specific numbers.
It absolutely requires running the numbers both ways. It's not something you can guess, but it's usually only beneficial in fairly specific circumstances involving AGI-limited deductions or phase-outs.
Okay, that makes sense. Because while the possibility of saving money by filing separately exists, you also hear about all the downsides, the limitations of choosing that married filing separately status. Listeners should be really aware of those too, right? What are those key disadvantages that often make the joint return the better choice anyway?
It's vital to weigh these disadvantages heavily, as they often swamp any potential benefit from filing separately. Choosing married filing separately generally triggers a cascade of restrictions.
Okay, like what?
First, and this is a big one for planning, if one spouse chooses to itemize deductions on their separate return, the other spouse must also itemize. They cannot claim the standard deduction.
Even if the standard deduction would be better for them.
Even then, if your spouse itemizes, you're forced to itemize too, even if you have hardly any deductions. This can significantly increase the tax for the spouse with fewer deductions.
Ouch. Okay, what else?
Second, in almost all cases, you cannot take the credit for child and dependent care expenses. This is a huge loss for working parents paying for childcare. Joint return is almost always better if you have these costs.
Right.
Third, as we mentioned, you cannot take the Earned Income Credit, EIC, flat out disallowed for married filing separately, another major benefit off the table. Fourth, you cannot exclude interest income from qualified U.S. savings bonds that were used to pay for higher education expenses. That tax break is gone. Fifth, you generally cannot take the credit for the elderly or the disabled unless you lived apart from your spouse for the entire year, meeting very specific criteria.
Okay.
Sixth, you will almost certainly have to include a greater percentage of any Social Security benefits you receive in your taxable income. The income thresholds where benefits start becoming taxable are much, much lower for separate filers, $0 base amount if you live together, compared to joint filers. This often leads to a higher tax bill on those benefits.
That's a big hidden cost.
It can be. Seventh, you cannot deduct the interest paid on qualified student loans, another very common deduction eliminated. Eighth, you cannot take the education credits, like the American Opportunity Credit or the Lifetime Learning Credit. Huge disadvantage if you or your dependents are in college. Ninth, you may have a smaller child tax credit and credit for other dependents than you would on a joint return. The credit amounts and phase-outs are generally less favorable for separate filers.
Less credit potentially, too.
Potentially, yes. And 10th, in most situations, you cannot take the exclusion or credit for adoption expenses, another significant benefit that's usually lost.
Wow, that's a really long list of disadvantages.
It is. And it highlights why, while the IRS says calculate both ways, these widespread disadvantages mean filing separately only makes sense in very particular, often quite complex circumstances. For the vast majority of married couples, even in community property states, the joint return will offer the most significant tax savings and, frankly, much less complexity.
Gotcha. So do the math, but be very aware of what you lose by filing separately.
Precisely. And building on that, if you do run the numbers and you find that filing separate returns is indeed your best tax-saving strategy, or if you're an RDP who must file separately, then remember, you and your spouse, or partner for RDPs, each must complete and attach Form 8958 to your individual Form 1040 return.
That allocation form again.
That allocation form again, it's non-negotiable. It's how you show the IRS exactly how you figured your share of the community income and deductions, which you report on the appropriate lines of your 1040, in addition to reporting all of your separate income and deductions. This detailed reporting is required for married filing separately in all community property states and for RDPs domiciled in Nevada, Washington, or California.
Right. And one little practical detail that seems easy to overlook when you're suddenly dealing with two separate returns instead of one joint one. An extension to file your separate return doesn't automatically extend the deadline for your spouse's return, does it?
That's a great point and absolutely correct. Once you decide to file separately, you're on completely independent filing tracks. If you need an extension, you file Form 4868 for yourself. Your spouse needs to file their own extension if they need one too. One doesn't cover the other.
Good logistical tip to remember. #TagV, getting tax help and beyond.
Now, navigating all these complexities, especially layering community property onto federal tax rules, can definitely feel daunting sometimes. But the good news is there are many excellent resources available, most directly from the IRS itself.
Yeah, irs.gov has a ton of info, right?
A massive amount. You can find virtually all the forms, publications, including Pub 555 that we've been referencing, instructions, everything. And much of it is available in multiple languages like Spanish, Chinese, Korean, Russian, Vietnamese, besides English. They also have newer tools. There's IRS Direct File, which is now a permanent option. It's a free online way to file simple federal returns directly with the IRS, though it's only available in certain states currently. And there's the long-standing IRS Free File program, where you can use brand-name tax software to prepare and file your federal return for free if your income is below a certain level.
And what about in-person help for those who need it?
Yes, there are great volunteer programs. There's VITA, Volunteer Income Tax Assistance, which generally offers free tax help to people who make $64,000 or less, persons with disabilities, and limited English-speaking taxpayers. There's also TCE, tax counseling for the elderly, which is fantastic for taxpayers who are 60 and older, offering free help, often specializing in pension and retirement-related issues.
Good resources.
And for military members and veterans, there's MilTax, offered to the Department of Defense, providing free tax software and support tailored to military life situations.
Beyond just filing help, IRS.gov also has some really useful online tools for managing your taxes year-round, doesn't it?
Absolutely. The tax withholding estimator tool is fantastic. You can plug in your expected income, deductions, credits, and it helps you figure out if you have the right amount of tax being withheld from your paychecks.
So you can avoid a big surprise bill or getting a massive refund, which just means you gave the government an interest-free loan.
Exactly. It helps you get closer to break even. You can also access your personal online account securely on irs.gov.
Right.
There you can see your payment histories, U-balances owed, get tax transcripts if you need them for a mortgage or student loan application. It puts a lot of your tax information right at your fingertips.
That's empowering.
It really is. And speaking of empowerment and protection, in this digital age, tax-related identity theft is a constant concern.
Definitely.
The most important thing to remember is the IRS never initiates contact with taxpayers by email, text messages, or social media channels to request personal or financial information. If you get something like that, it's a scam.
Don't click the link.
Don't click the link. Report it. If you suspect identity theft, or if you've been a victim, irs.gov identity theft is the place to start for resources and recovery steps. You can also proactively get an identity protection PN, an IP. It's a 6-digit number known only to you and the IRS.
How does that help?
It adds an extra layer of security. If someone steals your Social Security number and tries to file a fraudulent return to get your refund, the return will be rejected if it doesn't include your correct IPPIN. It makes it much harder for criminals. You can opt in on the IRS website.
Good tip. And if you decide to hire a tax preparer,
Choose wisely. Look for someone with credentials, ask about their fees up front, make sure they sign the return, and include their prepared tax identification number, PTIN. But remember, even if you hire someone, you are ultimately responsible for the accuracy of every single item on your return. So review it carefully before you sign. Don't just blindly trust it.
good advice. Now, what if you run into a problem with the IRS? Maybe a mistake was made, or you feel like you're stuck in bureaucratic limbo, or your rights aren't being respected. Is there anywhere else to turn?
Yes, absolutely. There's a crucial resource called the Taxpayer Advocate Service, or TAS.
TS, I've heard of them. They're independent, right, even though they're part of the IRS.
That's exactly right. TAS is an independent organization within the IRS. Their job is to be the voice for the taxpayer, to protect taxpayer rights, and help resolve problems that taxpayers haven't been able to fix through normal IRS channels.
And their help is free.
Completely free. They can step in if your IRS problem is causing significant financial difficulty, if you've tried to resolve an issue with the IRS but haven't gotten anywhere, or if you believe an IRS system, process, or procedure just isn't working as it should and is negatively affecting you or potentially many other taxpayers. They also work on identifying and proposing solutions for those bigger systemic problems within the IRS.
How do you reach them?
You can find your local taxpayer advocate's office and get more information on their website, which is taxpayeradvocate.irs.gov. Or you can call them toll-free at 877-777-4778. They really are a critical resource for ensuring taxpayers are treated fairly and that their rights, as outlined in the Taxpayer Bill of Rights, are protected throughout their interactions with the IRS.
That's great to know there's an independent advocate available. #HackOutro. Wow, that was a truly comprehensive deep dive. We've covered so much ground today on community property laws and federal taxes. From the absolute crucial role of your domicile, right down to the nitty-gritty definitions of community versus separate property and income, to how all those different financial items, wages, pensions, investments, even deductions and credits get treated under these rules.
Yeah, we went item by item on a lot of those.
We did, and critically, we explored that strategic decision-making around filing status joint versus separate, and why calculating it both ways is so important for anyone impacted by community property laws.
Absolutely. And I think the key takeaway is that understanding these rules isn't just about ticking boxes for compliance. It's really about empowering yourself to optimize your tax situation and hopefully avoid those unexpected and potentially costly liabilities. As we saw, even within rules that seem pretty fixed, knowledge gives you choices. Knowing about the basis step up, understanding the IRA rules, knowing when income from separate property is split, and especially knowing you can calculate your tax both ways to find the best outcome. That comparison is the strategy.
That really resonates. Knowledge empowers choices. So here's a final thought for you, our listener, to maybe mull over. Knowing all of this now, especially if you live in a community property state, or maybe you're thinking of moving to one, how might this change the way you approach not just your tax filing at the end of the year, but maybe even how you handle your financial planning, your record keeping, and even just your financial communication with your spouse or partner throughout the year? It certainly makes you think about being more proactive rather than just reactive when tax time rolls around. Thank you so much for joining us on this deep dive into community property and federal taxes. We hope this has equipped you with valuable insights for your own financial journey. Until next time, keep digging deeper.